I know that now it's not face to face. Some of you are having problems. Understand that to get through this assignment. That's the reason why I think the workshop is warranted. You look at my announcement. We have you can come to today's one. Excellent. I can see many people in the class. We also have another workshop on Tuesday next week, right? On top of that, I think basically assignments issues. So then we have a pretty good time, not only for today, but next week Tuesday I will have another live session as well, like this one. Plus my tutorial timing next week, all dedicated to this one or any other question you may have next week. That can be the last week for semester 2 in business finance, right? So I believe that now I have received, altogether now, to be honest with you, I have received 127 emails. I think this is the number of email I've really, I have a problem with business finance, corporate finance. I've told it before many times, and I repeat again, try to score as much as you can, right? Business here in Singapore, to be honest, my business is picking up here in Singapore. The pandemic is under control. Some foreigners in the room, they can witness it. Singapore, we are getting back to business slowly, right? So this is why I believe now in Australia they are controlling as well. What will happen? The pandemic in Australia will be under control. Make sure you finish your degree as soon as possible. Be in the market as soon as possible, because there will be a lot of opportunities to come in. After the pandemic, a lot of companies will need corporate finance, need advisory. I believe on that. I can see coming now in Singapore right now. So today the task is about the assignment. Let me go deep inside and explain what it's all is about. First of all, now this is when you look at your group assignment, right? So I give you first the summary of your data you have, right? So then after, let me present first. Then after the presentation, now I'll take a question from the floor. So in the option 1, you must understand what's happened is the following, right? You put down all the requirements. Actually, a summary. There's nothing here. This is all in a background, right? All the notes. Option 1, what is inside the numbers. I love numbers, right? What I advise you now, put down all the numbers as it is here, right? So you have to build building a crusher on a 13 kilometers conveyor, right? This is the data information. This I given, right? There's nothing secret here. This is a summary of all the data you have. So it just to build a crusher. There are 2 options by Rio Tinto. One is to do in-house, right? And this have a cost on option 1. And the second option now is very common. This is the real facts. It's the real things. You can really outsource another company to do it. In this case now, Rio Tinto and BHP, they are competitors, right? So, and they do this kind of thing now. Sometimes Rio Tinto asks BHP, can you help to do this construction, or vice versa, right? So then option 1, this building a crusher and a 30 kilometers conveyor, all right, it be done by Rio Tinto itself, by the company itself, right? So this is the data information now. That is nothing new. Right? So the new crusher and conveyor is a $24 million, right? To build an unfull facility, right? It's a $8.2 million, right? And the pump, flotation, and other equipment now, $7 million, right? So then you have a reserve fleets per year, right? So that's gonna cost $1,030,000, right? So revenue per year, be careful here. Revenue per year is $18 million. But if you read carefully now, that revenue per year will increase but 2.5% per year. Be careful here. Of course, now, what does it mean? At the end of the first year, $1 million for sure. Then you have to factor here 2.5% increment year after year. After the first year is $18 million. Then you need to calculate now the revenue in the second year and the revenue in the third year. They won't be the same. The revenue in the first year will be different from second year, and the second year will be different from third year, right? Because of this indication here. Be careful. For the number of engineer, right? Now, you cannot talk about compounding here. Let me finish first. Then it's not a compounding. It's not a compounding at all. Compounding only refers to interest rate. Here is an increase on the number. First year, end of the first year, revenue, $18 million. Second year, how much is it? And third year, how much is it? Let me give you tips here. The first year number is not equal to the second year number, and the second year number is not equal to the third year number. Okay, Harry. Thank you. So, number of engineers, there is a new engineer, 7, right? 7. And the new engineer is given explicitly salary per engineer, $144,000, right? It's given. But there is a number of old engineers. So be careful here. So you need to look at now, having a new engineer at 7 and having an old engineer, is the company gonna lose or you gonna win out? So then if the company gonna win it, because even new engineer costs less than the old engineer, so that difference now become positive sign, if not become negative sign. So you gotta be careful here, right? So the old engineer, that is $105,000. Based on two numbers here, you will know now how much it's gonna cost or is benefit for the company to do so, right? So you have to be careful here. So I won't tell you more, but there is a tricky part here. You have to be extremely careful here, right? So that way, there could be an increment in the salary or not, right? So you have to look at it. It could be in that they have to look at the difference between having a 7 new engineer against the 11 old engineer. Is the company gonna benefit out of it, or the company gonna lose out of it, right? So that is important. So let me carry on here, right? So I'm gonna go to the numbers first and clarify. So remaining labor costs, right? This have to be done is $6,200,000 per year, right? Incremental or decremental salary, we have shown it in the profit. Yeah, I mean that. Harry, just cool down. I will go to profit and loss account again. I will go to cash flow step. I will go to every single step, right? I go to every single step. No worry, Harry. I know you are very dedicated, but let me finish first. If you interrupt me, then it won't be fair to other people, right? So let me go slowly. Many labor costs is $6,200,000. I think the genuine concern of Harry, I understand. Many are confused. Which items should go in the profit and loss statement and which items to go to the cash flow statement? I understand that. I will clarify. Let me give you time to go through the numbers first. I will do clarify everything. For tax reasons, be careful here. And for cost, $8,200,000 is paid immediately. Means you have to take this one in consideration at year 0. For tax reason, it is absolutely clear. This $8,200,000 must go at least to a profit and loss account on the year 0, right? Immediately. This is a service value. So what is saying in a case, you have a crusher, 13-kilometer conveyor, be depreciated over 3 years, right? 3 years, right? And when it are depreciated over 3 years, then the service value, right? That means the crusher, the 13-kilometer conveyor over 3 years, the book value at the end of the 3 years becomes 0, right? So then you can sell it. You only sell it, you get $12 million. We know, I'll go through later how to put in the service value, like in the lecture notes, right? We have working capital in the case. This working capital is $6,300,000, right? This is required at year 0, right? And yet pay back this one at year 3. You know from a lecture note, this working capital, we never be appear in a profit and loss account. If you just go straight, we know you can check. You can take the lecture notes, you can take the tutorials, right? The working capital now is a cash flow, right? You require year zero, you take this money from your bank account, working capital $6,300,000, but you have to pay back at year three, right? So that means it becomes a negative value. In a year zero, it becomes positive value in year three in a cash flow statement. How many years for this project to live? 3 years. How much is my tax rate? 30%. It's very easy. You need to put down this one first, as I did here. Put down all costs first. Clear out 100%. Have a good picture. This is like it's down in the company, in the corporations. When I did advisory work, we need to know what's a facts. This is something is given, right? Then you have to classify in this manner, right? So then when you do that now, so you can go to the analysis, right? So the next one will be here. Step one, from a lecture note, let's refer to it. There is a depreciation computation, right? Depreciation computation. Be careful here. Let me guide you here. So there are two items, a new crusher and a conveyor. That is $24 million. The pump and flotation now, $7 million. These are the two items will be depreciated, right? So method, straight line, nothing here. This is in your, in the notes, right? Is a method, straight line, depreciation, right? Duration, how many years? 3 years. You know the values here, right? And for facility. Now, I already done. This is only here. Just look at the text. I can't tell you more than that. This is written in your in a case, right? You got it. Yeah, it's there. It's only new crash I put here explicitly. It's one new crash. Second is pump flotation other equipment. I put a number here. These are only two numbers. Be careful here. You have to refer to. This one is up to you, right? And this new crusher and conveyor and the pump flotation and other equipment, very precise way, will be depreciated. Now the question for you now, you know the amount of depreciation. How much is it? You can calculate. So the straight line have to be applied. You need to know the total depreciation now. How many years? So once you know the amount of depreciation now, then you can put this one in a profit and loss statement, right? It's clear, right? So that's the way you have to look at it now. So the depreciation will all happen at the end of year one, at the end of year two, and at the end of year three. Never in year zero, right? So then you get it. Step two, I follow my lecture notes, all right? I follow my recorded video for this one. You have to calculate the gain or loss from sale. So this is a formula I gave you. You have to apply it. It's the salvage value minus your book value. In this case now, be careful here. I cannot tell you the numbers, I'm not allowed, but I can guide you. You need to know the salvage value is given. You need to know the book value. Based on this one, you will know the book value, right? So then the gain or loss, as you know, that amount, right? It will go where? The gain and loss go to your profit and loss account, right? Use value of asset. No, Harry, you can't. Just follow the lecture notes. This is the salvage value is given, right? It's given to you, 100%. And the gain and loss, right? The gain and loss will be computed when at the end of year three. That's it. When the crusher and associated system equipment, this is value is given. So if book value is zero, salvage value is the gain. Yes, that is correct. Yeah. The book value becomes zero, then the gain or loss becomes the salvage value. Correct. Yeah. These are numbers I cannot tell you. Right? You have to calculate. It's not fair. Right? Perfect. So now the crusher, thank you, Harry. I got it. Okay, good, good. I'm happy you got it. Excellent. All right, let me continue. Actually, it's very clear, right? Just go to the lecture note. You can get, but is a you need to know the book value. But you remember now, this new crusher and pump will be fully depreciated, right? What does that mean? How much will be the book value? The gain and loss formula is the service value minus your book value. You should know how to put in. It will be going because it loss. That amount will go straight to your profit and loss account in a year three, right? Because you cannot do in a year three. Now we cannot record this one because the student asking a lot of questions. I want to keep private. It's privacy, unfortunately. Yeah, I cannot record this one, unfortunately. Unfortunately, because it's a privacy. I respect my students. I don't want the question to be seen by everyone, right? So sorry about that. But you can come back again. I'm happy to share my questions. That's okay. But the other people are not happy to do that, unfortunately. Yeah. Yeah. So, but I think you don't need to worry. There will be another session on Tuesday. Maybe I'll look at that session to see can be recorded. You're gonna see, right? But today, I promised to many students, it's not recorded, unfortunately. But it's all here, right? Yeah. How time? Let me go first, and I go to question. The work limit now is 4 to 6 pages, right? 4 to 6 pages is a requirement. Work could be anything. 4 to 6 pages, right? It's in your assignment, right? So let me continue. I know that maybe I will have a time for you. Let me finish first. I have time for you to ask question. If not, I won't be able to present everything, right? So the gain and loss is calculated. So let me go to the next step. So the next step will be step 3. You have a profit and loss statement. For tax reason, you will expect the cost of unfold immediately. So the cost of unfold, see, this is too sensitive today. Let me get a new pen. Okay. Done. Good, good. Just relax. We'll be okay. I will take all the questions. I will answer everything. I want you to do well. That is the whole idea. So profit and loss statement here. For tax reason, you will expense the cost of the unfold, right? You know that this is given, right? The cost of unfold immediately, right? So then in a profit and loss account, you need to get unfold facility. Hurry! Unfold facility cost, it need to be taken out at year 0 straight away for tax benefit, right? It's clear. Revenue. The revenue, check my lecture note. I will refer you to my video recorded, right? Revenue will appear in a profit and loss account in both accounts. Revenue will appear in profit and loss account at the same time in the cash flow statement. Here, be careful here. You can give me the first year. You're gonna be $18 million per year. Correct. The year 2 and year 3 will be somehow different. But it's increment. It costs. It's a 1 million because it's stated clearly, absolutely clear. The fleet has been earning a rental income, and that fleet will be used. That is lost, right? That is called operating cost. Is $1,030,000. Additional labor cost could happen here, right? So this additional labor is given, right? It's gonna be $6,200,000, right? So it said that the 1,000 additional construction labor required for this project is expected. It had to go to your profit and loss account, right? So that's it. This one you need to be extremely careful and look at now what you need to put in. So in the cash flow statement, right? If these are all your bank account transactions, you have to look at it now. So then what will happen? Your profit and loss account will allow you to calculate your tax, right? The taxable income. So when you get a taxable income, you have to pay for it because you're gonna affect your bank account. So that amount now, what we get now on the tax, your taxability, or if you want tax benefit, right? So the tax rebate, that will be reported in the cash flow statement, right? You know that. Revenue is a cash flow statement as well. The same revenue in a profit and loss account must go to your cash flow statement. Service value, we know that this is gonna be, you're gonna sell it. I mean, at the year 3, we talk about it, right? And that amount now, service value amount, would go and increase your bank account, right? So, working capital, of course, you have to take it from year 0, you pay back in year 3. So these are clear will happen here because a new crusher, right? And for facility, of course, these have to be paid for a new crusher. And for you have to pay for it. The pump and flotation, right? Over equipment, right? Working capital, right? These are unquestionable, right? Yes, this one, you know that, Harry. You go to your lecture note, that's right. But the reflection now here, I had to draw attention immediately. You have to be careful here. It's a reflection here. Because in your profit and loss account, this way I can see a lot of confusion now. Where are you gonna put your opportunity cost? Where are you gonna put your additional cost, right? You know, you're combining now 7 new staff against 11, right? Here's additional labor cost. Where are you gonna go? And where are you gonna put your incremental, no, additional labor, sorry, additional labor is given, additional labor cost is given. Where are you gonna put it? And this is a incremental salary. The salary now between your old employees and your new employees, what's the difference net? Is it positive or negative? So these are the 3 items here. You have to be extremely careful on how to classify. They should go to profit and loss account, or they should go to cash flow account, or both account. That's a turning point, right? So that's a turning point. Okay. So that's it. So this is all about your assignment for option 1. Let me go now for option 2, right? Can you explain initial outlay? What do you mean, Harry? Let me go first, Harry. I've finished this and I won't be able to terminate. I'm sorry. Point number 2, option 2, right? Option 2, BSP can be contracted, right? We know that. We need also to calculate here, when you come now here, be careful here. Let me go to option 1. When you come to your profit and loss account, you will know how much tax to pay or how much tax revenue you have received. Then that amount go to your cash flow statement, right? Then from there now, you need to find what is your net cash flows, right? For year 1, year 2, and year 3. So then you have to get the present value of the cash flow, right? For year 1, year 2, and year 3. And if your present value, your NPV for option 1 is positive, you can proceed, right? If it's negative, you don't proceed. You just follow the classical process. Let me go now to option 2. A BSP can be contracted, right? To supply the required iron ore. Fine. The cost of BSP here is $25 million. Advance payment is given for BSP I0 is $24 million. Remaining paid equally each year. Then if you take 24% of $25 million, that is paid at year 0. Then the balance amount, you have to divide it by 3. That will be split in year 1, year 2, and year 3 as a payment. Processing costs each year, end of each year is given. Year 1, year 2 is given, right? Revenue is the same as per option 1 as well. If you miss the revenue computation in year 1, you're in trouble for year 2. It's the same, right? So this is where you're gonna work explicitly. For option 2. Remember here, there's no depreciation, there's no service value here. Absolutely non-existence, right? So basically, you have to be careful. So on your profit and loss account, it should be a lot simple, right? Lot simple. Processing cost is every year. It's given to you for option 2, processing cost. For year 1, 2, and 3, it's $6,200,000, right? For year 1, 2, and 3. You know that, right? So revenue is 1, 2, and 3. Processing cost, revenue, all go to your profit and loss account. You know that now. And the BSP cost per year is also going to your profit and loss account, also on as you know, on your cash flow statement, right? The profit and loss is not mentioned now, but if you look at my lecture note, this is a P&L, because P&L, P means profit and loss, right? Statement. It's profit and loss statement. It's not account, sorry. It's a profit and loss statement. Cash flow statement, profit and loss statement. I'm sorry if I use account. It's a statement. Yeah, I want to touch on the work in a minute. That is done. So thank you, So that's it, the option 2. I think we have now. No, the amount of revenue is given. Let me finish first. This one, I'll go back to your question if you don't mind, because I know that many here. I'll go to option 2. See, I want you to be very careful. We don't have enough time, but I have a 15 minutes or 20 minutes for your question and answer in a minute. BSP can be, I paid now option 2. Too many interruptions. The cost of BSP, $25 million, right? Advance payment of BSP, 24%. That's going to pay immediately, right? I have to pay that. I'm gonna pay in year 0, right? 25. So then the remaining amount, when you pay 24%, so the remaining amount, so that needs to be split in year, 1, 2, and 3. Year 0, we already have a cost. That cost 24% gonna be $6 million. You know that, right? So then the remaining, right? Yeah, it says it's correct. Yeah. Processing cost each year is given, right? So revenue is given. The revenue amount is given. Don't look, the revenue amount in the first year is 18 million full stop. Then you're gonna increase 2% every year. Be careful, I repeat again. $18 million is for first year for revenue. Second year is different number. Third year is also different number. The 3 revenues are different each year. You have to calculate, right? So that way you're gonna be strong. I give you everything already, right? But I can't give you numbers, right? So let me go to way. Immediately, we have another few minutes to go. Step 1, what are the all relevant items? All relevant items. I need attention here, be careful. Then I'll take your question, if you don't mind, please. It's very essential to understand the concept. Then we go to the questions, okay? We have ordinary shares, right? We have a preference shares. These are equity items. You cannot miss that. No, interest expense is out. Right? Don't take interest expense. This is, you don't need to worry about it. It's double counting because anything about the interest is really in a discount rate. So you should never put the interest expense anywhere in a profit and loss account or any cash flow statement. Right? Good. Let me continue now here for way, if you don't mind. So let me continue. So what are the all relevant items? Ordinary shares, equity, there are 2 items. What are the debt items? Overdraft. Be careful here. You have a debt. Sorry, T is missing. 2, term loans, mortgages, right? Secure notes is out. We only limit to 6 items. Here we get a 4 plus 2 for equity items. That's 6. That's it. Secure note exclude. Step 2, market value of items. Equity items is number of shares is given. Times the share price is given, right? It's all there. You calculate the market value of that. So the items. Bond price formula. Okay, let me guide you here immediately, right? For bond price formula, you apply to calculate your debentures market value and the term loans is the same way. Okay, debenture and term loans. You apply the debentures, right? You apply the bond formula, the bond price formula. I'll go through in a minute. No issue. For debenture number of years to go 6. How many payment will be? 2 times 6, right? N will be 12. But let me be more detail here to be precise, right? Be careful. Let me give you an idea here. Debenture formula, this way to use, right? Bond price, PMT, right? This is the PMT is a coupon payment, right? For debentures and term loans. These are M way to calculate here the market value, right? So be careful here. So 1 plus R, 2 power minus N, R, plus the face value, 1 plus R minus N, right? This is a bond price to calculate. So the debenture now, face value is, is right. It's 88 million. Here, be careful. It's only one. You don't need to see how many debenture was issued. No need here. It's excluded. It's only $188 million. That's it. Right? So you don't need to worry anything anymore. That's okay. $88 million. PMT, coupon payment, right? Twice a year. So it's twice a year. Be careful here. It's twice a year, right? So that means you do the coupon rate divided by 2, right? It's twice per year. Never forget that. N is 12. I've told you before, right? It's a 6 year. It's a 2 payments per year. That will be 12. Term loans, face value is a bit difficult here. $67 million, right? PMT, you pay 7.2 twice a year. Multiply, this is the same, you calculate PMT for the batches. Same way, right? Here, 6.8%, right? Twice, yes, also divided by 2, right? It's a compounded twice yearly. Then your R you're gonna use here is compounded twice, right? And the PMT you calculate is also paid twice per year. Okay, so then use the formula, right? The bond price, use the same formula here for the term loans, right? This here is the formula. And for term loans is a 5 years to go, twice payment, 2 payments per year. You're gonna be end of a payment of 10. I gave you everything. Right. So this you have to be confident. Because I don't believe on it being you have plenty of numbers that are to help you to get numbers right. So now you're gonna depend on term loans, mortgage here. It's a bit difficult. Let me go to the detail here. I explain about the mortgages, right? So I will try to be fair. Step 1, you must calculate the mortgage PMT based on old number. Very important on step 1. This is where to do first. The number year is 4, right? Number of payment per year, 2 payments per year. The old interest rate is 7.3%. It's compounded twice yearly, of course. And the new interest payment, 6.45%. And the face value is given, right? It's $91 million. So what you should do first, in the first step, you put $91 million in face value. It's equal now, is the present value of an ordinary annuity. Because here for mortgages now, you pay at the end of the year, right? The mortgage, that means it's one period lag. Is the present value of an ordinary annuity formula is here, given to you. Right. So you get now your PMT. Here, this R to use now is all interest rate to use first. Right? So you get now your PM, you derive your PMT. Once you get your PMT, what you do on step 2, present then the market value is based on a new interest rate using PMT. What's happened? No, wait, Harry, wait. I'm busy. Don't interrupt me, please. You've been in trouble, Harry, okay? All right, so let me continue. Harry is very excited. Step 2, when you get a PMT, right, then you calculate present value based on a new interest rate, right? So use the PMT calculated in step 1. Then this PMT you get now, so this is the unknown now present value to calculate, right? So then the PMT here is the one you have calculated here, right? So that is then 1 plus the new interest rate 6.45%, right? Divided by 2 is paid twice a year, minus N that is 4 years to go, 2 payments per year, N is 8. This is your R, isn't it? So then you get a market value of your mortgage here. Very important here. This is a confusion. Many get trapped here. This is where I repeat again for your understanding. First, you need to use the old interest rate to calculate first your PMT, and using the face value given, then you get R is given on the old interest rate. Be careful here. It's 7.3% divided by 2 is paid semi-annual, and N is what? N is 8. Why 8? The mortgage is 4 years to go. 2 payments per year. That become 8. 2 times 4. Once you get the PMT here, calculate now the market value of your mortgage. Then it's equal to PMT again. That's the PMT to use, the one you have calculated in a step one. Then you plug in here. Now you have changed. You use now the new interest rate. That is now 6.45%. But it's paid twice a year. It's here. Right? So then you get here the present value of your mortgage. God bless. Right? After that, I continue. So step 3, you calculate the before tax cost, ordinary shares. You apply. Come on. Don't forget to copy beta. It should be less than 1 to give you tips. Preference shares. How to calculate the cost of preference I give to you here is a bit complicated. Is it 3.10%? The old price is 81. So you get it now. The dividend is 2.51. So this is the new share price. The dividend over P0 give you the dividend yields, right? RE. This is the way you should get. I give you here tips for your preference shares, not for ordinary equities. So the budget items here, be careful here. For all the debt items, all of them, you must make adjustment using effective rate, EFF. The budget 6.8 is given, but he has to use EFF for 6.8%. Term loans, same, 6.8% per year. You had to get effective rate. These are all compounded, right? They're all compounded. Mortgage, 6.4%. It has to be adjusted to EFF. Overdraft is the same as well. These are all has to be adjusted. That's the way to take it. And that gives you your before cost before tax cost. Then you calculate after the tax cost. There is no after tax cost for ordinary shares and preference shares. You forget about it. You only do after tax cost for the debt items, the bunches, term loans, mortgage, overdraft. That's give you your way. And adopt, then you can follow. You must use like a table to calculate the work on a set 7 steps. Right? That's it. That's it. Easy, easy, easy. I go to the next one. Debenture. Okay, let me come here. Okay, I can continue. Okay, fine. So when you iron ore, I have this need to. The last part, be careful here, is the prediction of iron ore price. Be careful here. So it's saying here the price only will drop by 10% per annum. So then what I wanted to do, if this is a formula, is the quantity times the price. So we really know if the price drop by 10%, that affects your revenue to drop as well by 10%. So the new revenue, you must calculate only the new revenue. All of the remaining remain the same. So then once you get a price drop, by 10%, you can presume that revenue also drop by 10%. That's one assumption you can do. And you calculate option 1 based on that and option 2 based on that, and to see what will happen. This is one other assumption now can be considered. That's you can consider. But what I wanted to do as part of your assignment, you put down the revenue by 10%. The price go down 10%. And how this 10% drop in the revenue affects now your NPV for option 1 and your NPV for option 2. That's the requirement, right? But then you can add on anything else you want. It'd be beautiful. But I will consider that, right? So technically now, net present value for option 1 and 2. Price for price analysis now. Okay, can I repeat again? What I'm saying, you have to follow carefully here. Price will drop by 10% per annum. So what I wanted to do to make things easy, you assume as well your revenue will also drop 10%. The drop in revenue of 10%, how this affects your NPV for option 1, NPV for option 2, and you make a decision. Doing that now is fine, but if you add on other consideration, based what will happen to the iron ore business worldwide for the next 5 years to come is up to you. Any other additional comment that is a free comment is welcome. I can give you the full mark, right? No, I does not disregard the 2.5%. You take the exact revenue you have, and on top of 2.5%, there will be 10%. So the flat amount of revenue you have already in your profit and loss statement and cash flow statement, you only deduct 10% on each of them. That's it was not clear enough maybe, but that's what to do. Yeah. Good, Michael Owen. Perfect. I'm waiting for you to get a 100% score on that, right? All right. So NPV option 1 and 2, 10 plus the plus analysis is 10. Give you. Can you repeat again? To repeat what? I repeat again. You have your revenue, right? In year 1, year 2, and year 3, there are different numbers. The same number you have now, you only need to deduct 10% on each of them. It's simple. Then you get your new revenue, right? Then you calculate your NPV accordingly. That's it. This is peaceful. The only unknown things you have to do is to reduce each year revenue by 10%. So then you will get. Then if you get now, you will know something will happen to NPV. Yeah, after 2%. Yeah, that is correct. If you want to say that after 2%, that is correct. Yes. I say Miss Love. Yes.
Yeah, just a question with the shares, the ordinary preference shares. I don't know which number to use because on that balance sheet, like the number is 28,030,000, and then but the number next to it is a different number, so I don't really know which number to use.
Okay, you use the old shares. You use basically 28,030,000. That's what you use. You multiply by the market price. Market price is 93.25. That gives you market value for the shares. Is that correct?
Yeah, and same for the preference shares. So you do $6 million.
$6,800,000. You multiply by 93.25 as well.
Yeah.
Clear?
So with like that 3.1% preference shares of $81 fully paid, is that just like a strict kind of thing, or?
Yeah, that allow you to calculate, as I told you just now. I'll show you on the screen. You have to calculate now the cost, before tax cost. You can see I use 3.10% is here, multiplied by the old number giving you dividend, right? This is your dividend. So that dividend now, you divided this one by the new market price by using preference shares, RE dividend yields. You look at my lecture note, this is the price, you use the cost before tax and after tax. Clear?
Yeah, thank you.
Perfect. Thank you, my friend. Ki Zhang, can you please go to the term loans? Okay, the term loans, I repeat again. That's really, I think there are a few questions coming. Now is a question time. The mortgage is here. Okay, let me hear. Okay, this is the term loans. The term loans are here, right? This is your PMT calculation, right? Use the same formula for term loans and debentures, right? The term loan to pay back again at maturity date, right? Okay. Wait. Revenue is not expense. Let me go to one question at a time. So there are so many questions coming in. So it's good. Let me go to the term loans and debenture. That was a question asked first. This is a question before. Let me answer the question. For debentures and term loans, as I say here, you use basically the same formula, like the bond price formula, to get a market value, right? So this formula is a PMT. You can calculate PMT easily, right? Is a coupon payment or interest payment here. For term loans, it's 0.72%, because it's a 2 year. This is the face value at $67 million. For debenture now, it's the same actually. The face value is $88 million. That's it. So 6.8%, right? This is the interest rate used in the formula. When be careful here, PMT use 7.2% for term loans, but the interest is 6.2%. That's different. Don't confuse that. There's always a PMT, coupon payment, interest, coupon payment, and the interest rate are always different. Okay, so what's the question again? Let me look at the chat box. A lot of questions now. Okay, is there any word limit? No, there's no word limit. We talked about that before. Let me go to, is the reverse float considered as revenue or expense? Reserve fleet. I don't know why you link here, because it can be used to make an expense, to build it, or it can be used to make money as well, right? It's incremental salary and the profit and loss or cash flow statement. You see, these incremental cash flows, you must understand clearly the incremental cash flow here. It must go, of course, to your profit and loss account. It's unquestionable, right? It has to be there, that's for sure. You have to consider that one 100%, and then you also have to consider to your cash flow to pay for it, right? So basically now, the question for you on is incremental salary and the P&L or cash flow both to answer to you, right? That's okay. Jonathan Anthony, so that's the revenue for year one also decreased by 10%. Correct. That is correct. Okay, Kizen, okay, thanks, Yu Yong. Michael Owen, where do we use the Excel document in our assignment? This is to calculate your beta, your beta calculation now. It should be there, right? If you look at the beta calculation, you can get it. Right? Okay, Harry, sir, if you can use decremental and salary, what do you mean by decremental and salary? I don't know that, Harry. You send an email, I will answer to you. Yeah, if you are saving, we don't use in business finance decremental, right? so it's called saving. Yes, it's a saving. It's gonna be passive value. You're gonna make a saving for sure on the 7th place to apply, right? That is okay. How 10? So we do not have to calculate. No, a secure loan is out. How 10? You only need 6 items, right? 6 items. Okay. So unsecured loan is out. Okay, Justin Trump. Let me now step by step. The question now for Justin. I was wondering, how do we set out our answer for work? Okay, is it similar to the table in the lecture slide? Yes, Mr. Justin, is absolutely similar. The way you're gonna present your work in the table is 100% similar what you're gonna have on the lecture note. Correct, right? Do we show our working out step for the work? Yes, you have to show it on appendix. Mr. Justin, if I appreciate it. Okay. Great child. In option 2, how do you treat the initial outlay? It's very easy. Initial outlay with $25 million is your initial outlay, right? But be careful here. That $25 million, you must split it. This is a very good question about, wait, child. Then you have to pay first on the first year, 24%. That go to year 0. And the balance amount has to be split in year 1, year 2, and year 3, right? That's it. Richard, right? So you will never see the amount of $25 million in any profit and loss statement or cash flow statements. Be careful. So the $25 million is split. The first 24% is paid on year 0. The balance amount is split in year 1, 2, and 3. Jump seed. Do we use the interest expense? No, we don't use interest expense. Forget about it, right? So it's a trick. We don't use anything about interest expense. Keys and form. Interest expense is a trick. Yes, it is a trick, my friend. I will get you. Keys. Cindy saying, isn't the reserve fleet a sunk cost? No, it's not a sunk cost. Forget about sunk cost. Trust me. Do we still need to include him in our table? Yes, you have to. Cindy, you have to. Nicolas Nguyen. We are outsourcing the iron ore from BHP and need to make payment to them. Since the iron ore price decreased by 10%, do we decrease? No, never decrease payment by that expense, Mr. Nicolas. Cannot. You cannot do that. In Singapore, we say cannot. No, you cannot do it. Right? Make it think simple, Nicola. Right? Very child. So it will be same as option 1. What do you mean? I don't understand. Because I put a question, I can say exactly what you want to say. Interest expense means cost of debt. Yeah, it is a cost of debt, Harry is asking me, interest expense main cost of debt. Yes, it is cost of debt, but it's really included in your interest rate. Then the interest expense is a trick. Don't take it. Miss Love, let's go to Miss Love. Is Simon asking for references? Are we expected to do further research on iron ability advisable? Yes, I will advise you strongly, right? It's very competitive. These things like that reference, you have a good reference here, make case strong to get it almost 40%, 100%, right? I will advise you, Miss Love, to do. Adrian, do we do our working out for work on Excel spreadsheet or using Microsoft Word equation? You can do whatever you want, Adrian. I just want to see your full computations, right? It's up to you. Krista, what does include the interest expense? What was that don't include, Krista? No, interest expense is just only a trick because it's double counting. If you take interest expense again, you're going to double count, right? That's what I said to you, right? Okay, you missed my second. Okay, what's your second question, Miss Love, right? Okay, let me say, asking reference. Okay, for 10%. Also, can we handwrite calculation for work? Then, yeah, it can do that. You can handwrite your calculation for work, and then you put it up. But I want your table to be clean table typed, please. Right? Handwriting to explain the calculation is like, but I want to save the table in the proper format. Careful here. You have a mark for presentation, right? Okay. Okay, Krista, thank you, Krista. Yep, thank you, Miss Love. Justin, do we round up? Okay, if you look at now, Miss Justin, running for interest rate 4 decimal point. It's already, I give you indication in your case, right? It's there for all interest rate. We go to 4 decimal point, right? Do we round also for each step in our working of you go to 4 decimal point, and the number is a 2 decimal point. For interest rate 4 decimal point. It's explained in the notes, right, Mr. Justin? Good child. Will we need include grant salary in option 2? They don't talk about option 2. Just no, you don't need to include it at all. Option 2 is very clear, right? As I told you before, is the processing or cost, BSP cost per year, and the revenue. That's it, and the tax for your cash flow statements, right? That's it. Rich child, will we need to include grant salary in option 2? No, you don't need, right? No need. Now, but Jing Chit, I missed the 6th page. Could you please show me again? Oh, let me try to, when I finish, I'll show that to you again if I don't forget, right? Okay. Jonathan, from the assignment, which part is profit and loss statement? Okay, Jonathan, you must look at my lecture notes that you have a different steps. You have a step for depreciation. You have a step now for gain or loss, right? Step 3 is your profit and loss statement, and step 4 is your cash flow statement, right? That will help you to calculate your net cash flows. You follow my lecture note, right? That will give you, Jonathan, every single steps, right? Profit and loss statement is there, right? It's a P&L, right? Which week is it? I don't recall. You go to the capital budgeting, you look at it. I don't want to give you the wrong information. But it's under capital budgeting 1 and 2. It should be there, right? It's a week 7. It's a week 7. Thank you, Harry. Okay, Jonathan, I have Harry in the room. Harry knows everything. Harry says week 7, Jonathan. Thank you, Harry. I appreciate it. Okay.